Welcome back into lesson 3. In this lesson, I'm going to cover some basic understanding of Chapter 13, bankruptcy, and how it relates to investing in mortgage notes. We'll start by defining an important document called the proof of claim. A proof of claim in bankruptcy is a document filed with the court so as to register a claim against the assets of the bankruptcy estate. Now, the claim sets out the amount that is owed to the creditor as of the date of the bankruptcy filing. Now, proof of claim will outline the debts that are secured and the debts that are unsecured. Secured debt is debt backed or secured by collateral. In the case of a mortgage, if the borrower defaults on repayment, the bank seizes the house, sells it, and uses the proceeds to pay back the debt. Just as there are performing and non-performing notes, there are performing and non-performing bankruptcy notes. And there's a mixed view about whether performing BKs are more attractive than other types of performing loans. Now, a solid performing Chapter 13 loan is viewed by some investors as a great opportunity because the borrower's financial situation, in some cases, has finally been cleaned up. Additionally, the cash flow from the arrears can boost the return. Now, arrearage, or also referred to as arrears, is the amount overdue on the loan. Now, under a typical BK plan, the borrower's catching up on the arrears while also making the contractual payment that they were supposed to be making before they filed bankruptcy. In other words, there are additional cash flows from the original payment plus the amount that's being caught up. Now, the technical terms for these types of payments are pre-petition or contractual payment and post-petition or plan payments. Let's talk about some considerations with a non-performing bankruptcy loan. During a bankruptcy, most collection efforts cease due to what's called automatic stay. And when a creditor wants to continue to collect from the debtor during the bankruptcy, it can seek permission directly from the court to do so, known as lifting or getting relief from automatic stay. The creditor must do this by filing a motion with the court, and that motion is called a motion for relief. You might hear this referred to as an MFR. And that's important to note that there are restart states and non-restart states with respect to foreclosure. Now, this determines whether the creditor can resume the foreclosure from the point where it left off just prior to the borrower filing bankruptcy. Now, restart states are typically preferred by lenders because they can complete the foreclosure quicker after they've gotten relief on the bankruptcy. Now, one thing to look out for is a repeat filer, which are borrowers that file bankruptcy multiple times just to block the foreclosure. Okay, so this brings us to the end of Module 4 on pricing notes. Let's go ahead and recap the big ideas. The key pricing variables for performing loans are credit, the note rate, the loan to value, which determines the equity position, and the pay history. The key pricing variables for NPLs, or non-performing notes, are the value band, the geography, the loan to value, and the stage of foreclosure. Now, there's a higher demand for notes in the higher value band range amongst the institutional investor. Conversely, the lower value band tends to be more attractive to individual investors. And finally, while some investors may steer clear of bankruptcy files, there is an opportunity for investors that understand the nuances. The next module is all about the due diligence process. Look forward to seeing you there.